Chapter 28 Exchange Rates for A-Level Economics. What is an exchange rate? Definition: the price of one currency in terms of another. It tells us how much of one currency is needed to buy another. Example: 1 USD is equal to 100 INR. A product costing $5,000 in India is equal to $50 in the USA if the rupee appreciates to 1 USD is equal to 80 INR. The same $5,000 product now costs $62.50 in the US. Types of exchange rate systems. Floating exchange rate, determined slowly by the market forces of demand and supply for the currency. The government does not intervene to control the rate. Examples: US dollar, British pound, euro. Why is a currency demanded and supplied? Demand for a currency causes appreciation to buy a country's exports, goods, and services for foreign investment in the country. Speculation that its value will rise. Supply of a currency causes depreciation to pay for imports, buying foreign goods, for investing abroad. Speculation that its value will fall. Depreciation of a currency. Definition: a fall in the value of a currency relative to another. Example: 1 USD is equal to 100 INR. 1 USD is equal to 110 INR. The Indian rupee has depreciated. Effects: exports become cheaper for foreigners. Imports become more expensive for locals. Good for reducing a trade deficit. Appreciation of a currency. Definition: a rise in the value of a currency relative to another. Example: 1 USD is equal to 100 INR. 1 USD is equal to 90 INR. The Indian rupee has appreciated. Effects: exports become more expensive for foreigners. Imports become cheaper for locals. Can worsen a trade deficit. Causes of currency appreciation: increase in exports, rise in foreign investment, higher interest rates, speculative buying, lower inflation. Causes of currency depreciation: increase in imports, fall in foreign investment, lower interest rates, higher inflation, political or economic instability. Impact of depreciation on the economy: exports increases and imports decreases, aggregate demand AD increases, economic growth increases, unemployment decreases to meet higher export demand, inflation may increases due to more expensive imported raw materials and goods. Impact of appreciation on the economy: exports decreases and imports increases, aggregate demand AD decreases, economic slowdown, unemployment may increases in export-oriented industries, inflation may decreases due to cheaper imported goods. Exchange rates and the balance of payments. The current account is highly sensitive to exchange rate changes. Depreciation improves the current account. Exports rise, imports fall. Helps reduce a trade deficit. Appreciation worsens the current account. Exports fall, imports rise, can increase a trade deficit. Speculation and hot money. Speculation: buying or selling currencies to profit from expected future price changes can cause extreme volatility. Hot money flows: short term capital moving quickly between countries to chase higher interest rates. Summary of key points: exchange rate, price of one currency in terms of another. Floating rates are set by demand and supply. Depreciation decreases value, increases exports, decreases imports, increases growth, increases inflation risk. Appreciation increases value, decreases exports, increases imports, decreases growth, decreases inflation risk. Movements directly affect the balance of payments. Thank you.